Welcome to Markets Today. I'm your host, Mbithe Muema. Now, today is a very interesting day for the economy of Kenya. We are seeing the economic survey being launched, which will be detailing the growth that the economy actually had in the year 2019 vis-a-vis 2018. We will keep you posted on these growth numbers as they come along. But moving over and above that, we will be giving you an overview of what happened in global markets overnight. What do we expect to happen today on the Nairobi Securities Exchange? And more importantly, what do we expect the outlook to look like for equities going into the better part of the year? On a global stage, we have seen oil continue to slump, with the U.S. oil futures actually leading this slump. We saw some of these futures for the July contract touch a low of about $13 per barrel. Brent crude was closed down at about $19.5 per barrel, and we continue to see weakness in this oil market, especially as we get into the May contracts, or rather the May 1st date, which is when the OPEC countries are expected to slash supply. Globally, the two key things are driving this downward trend in as far as oil markets are concerned. The largest oil buyer has said that they will cease buying oil, and the reason for this is largely looking for liquidity to be able to meet their own financial obligations. The second cause for the downward trend in oil prices has been caused by an oversupply in oil, largely related to the COVID pandemic, which has caused a lockdown and made everybody stay home, thereby curtailing demand. Earlier in the week, we had still a bit more positivity in this market as lockdowns started to ease, but then there is the possibility of a second round of this disease. So a lot of uncertainty happening in that market, and it's actually having a mixed bag in terms of the impact on equities. For the case of Kenya, Monday was a very slow day. We saw turnover dip at the beginning of the week. Foreign investors continue to sell out of this market, and they were selling out of Safaricom and some of the banks. Safaricom closed at 27.5 shillings per share, and it will be announcing its full year results tomorrow. The company will be hosting a live stream event in line with some of the measures that the government of Kenya has instigated in terms of social distancing and avoiding group gatherings. If you do like, you can always follow me on Twitter, that's Mbithe Muema, just to get the details of where this live stream will be happening, or you can also follow us on Metropole TV for further information. By way of expectations, analysts are expecting about 10 to 13% growth points for the earnings that come out tomorrow, and key in focus will be the last 3 months, understanding what COVID has meant in terms of M-Pesa operations and pricing of this product. Two other things are happening in the market today. KCB and Standard Chartered go ex-dividend. They had pronounced final dividends for the year at 2.5 shillings and 15 shillings respectively. The record date was yesterday. Today we expect a downward correction for KCB, minus 2.5 to trade at about the 34 shilling level, and for Standard Chartered, minus 15 shillings to reflect this dividend. We expect it to trade about the 178 level, give or take. When we are looking at COVID and its impact on wages and pensions, the regulator, that is the Retirement Benefits Authority, has come out and said that it is extending a premium holiday to pension companies that are actually affected negatively by the COVID. Key sectors include tourism and the restaurant and hospitality sector. RBA has actually come out and said that the companies that have been paying a pension for their employees can actually come and negotiate or even choose to suspend their affiliated pension liabilities if they're unable to make payments. Over and above that, RBA has also come up with measures saying that if any of the employees actually go on extended leave of absence, that the companies are not necessarily required to make these contributions in as far as the pension assets are concerned. Now, today we want to understand, with COVID, what does this mean for the growth of pension assets? This is a very topical conversation for us today, largely because the NSC has been driven by the local fund managers buying. Now, what will happen? Will liquidity hit the asset managers? Will we see a drop in demand from the local fund managers? In studio, via video call, we are joined by Reginald Kadzutu, who works at Zamara. Reginald is responsible for retail and saving solutions at Zamara. He also looks at pensions and insurance, and is really engaged in terms of building the assets that Zamara has. And he also has a lot of oversight in terms of how pensions are analyzed, collected, as well as allocated to different asset classes in this economy. Welcome to the show, Reginald. Okay, Reginald, fantastic. Welcome to the show. There's a lot of things that are happening, but for us here at the NSC, we have seen local investors continue to buy into assets. In a space where global markets have been affected by COVID, Kenya has not been affected. Maybe you can give us a view of what your thoughts are, what is driving this, and what should we be looking out for, at least for this week? Okay, thank you for that overview. What you're really saying is the demand that we're seeing in the market, it's not driven by the underlying fundamentals, but it's more of a strategy of averaging down, or at least just ensuring that your portfolio allocation to equities is more or less constant based on the obligations that you have to your trustees. That said, we have seen RBA come out and say, okay, you don't need to pay your pensions if you're unable to. Last year, we had seen a bit of good numbers in terms of growth numbers coming into the pension industry. Is that a scenario that you expect to continue, at least in this year, given what has happened with COVID? Interesting when you bring up people who are about to retire, because we did see the tax amendment bill that was passed over the weekend and discussed in Parliament last week. It had a raft of measures that were talking to this particular group of people. And some of the measures were, if you actually get your money out and put it in real estate, then you sort of get waivers. What are some of the measures that government was seeking to actually put in place to be able to mitigate the people who are retiring or people who are just in the pension industry at this point in time? About this 5% extra income that the employed have gotten, what are you telling them to do with that money? Are you telling them to invest? Are you telling them to spend? Are you telling them to put it as part of their pension assets? What general advice and sentiment have you gotten in as far as this is concerned? for a rainy day. So what the government has done is that it has helped you start thinking about an emergency fund. Let's go to the other side in terms of infrastructure bonds. This was also mentioned in the tax amendment bill and the proposals. What is your thinking in terms of investing in government debt? Is investing in infrastructure bonds still tax-free? If we invest through the stockbrokers, are we going to be taxed now? What are your thoughts and sentiments on that? Okay, let's just take a quick break and we will be back. Look out for us on Twitter. That's Mbithe Muema or Metropole TV. Let us know what are the key concerns that you have in as far as your future retirement is concerned, and also with regards to allocating any extra income you have now to different investments. We take a short break. We will see you shortly.